Good morning, everyone. Welcome to this update for global stocks, commodities for the 5th of November. The US market finished in very powerful fashion on Friday night, and we had a terrific week of earnings. And it's hard to see anything other than a continuation of this amazing run, but it's a run that's certainly being underpinned by good, solid fundamentals. So let's jump in and have a look at the agenda for this update. But I'm going to have a look at the likely run into to the year end, and in particular what both the fundamentals and the charts are telling us. The normal stock and commodity trend update, and just to recap, as you may know, there's a free trial available on Portfolio Analyst, and last week we covered 7 local Australian stocks, 4 US stocks. There were a couple of strong buys, and also I talked about a very exciting upcoming IPO. And I also reviewed past strong recommendations and also looked at the US tech sector. So all of that was in last week's Portfolio Analyst. And for anyone that's not a member, if you wanted to take advantage of the 2-week free trial, then you could access all of that information and all of the prior weeks before that as well. So let's get on with it. The American stocks, the S&P index moved 7 points higher again and finished right on the absolute highs of the week. And of course, the all-time highs. And there was even a lackluster jobs report, which didn't really dent the market's enthusiasm. But that was offset by some strong PMI, Purchasing Managers Index data, and of course the earnings that were coming through have been as strong as ever. So we're probably about 70% through the US earnings season now, and it's been yet another good one. And especially by the stocks that I'll call the dominators, the Apple, Amazon, Facebook, Google, Alibaba, those sort of stocks that are really just becoming absolute global dominators. And it's hard to see that situation changing. And of course, tech stocks, which have been rising now for 2 or 3 years, have been one of the best performing sectors of the market. They're justifying their price rises with good earnings growth. You know, there's a human tendency to see a long-term trend that just goes on and on and on, and people think that it must be a bubble. But in tech stocks, it's not. The price rises are well and truly being backed by really good, strong earnings growth. And the PE multiples for these stocks have really only increased very, very slightly. It's all about earnings. So I would expect a good run to year end from here. We might get, of course, a little bit of a pullback, some profit taking. That's just normal human psychology. But putting that aside, I'm very confident the US market is going to be higher at the end of the year than where it is now. I can't say the same thing about the Australian market because it's so dominated by the banks, and the banks have certainly got some headwinds. Now, the US dollar continued to trend higher, so it's been quite an impressive bounce back, and with the likelihood now, it's being priced in at nearly 95% likelihood that the US Fed will raise interest rates in December, and so the US dollar trend is probably going to continue. And here's a graphic that really illustrates what I'm saying about the fact that prices are just tracking earnings. So on the blue line, which is the scale on the left-hand side, is the S&P 500 index, and the red line is effectively earnings for stocks. And you can see that they're just tracking each other along very nicely. So the market is not really getting ahead of itself to any great extent, and that's quite a long-term chart. So let's take a look at some of the action. This is the S&P 500, and you can see we just continue to work our way higher. The price is considerably above the 50-day moving average, and of course miles above the 200-day. But it's not really getting that far ahead of itself. We had, as you can see back here, the market index really spiked up in March, and then we got a bit of a pullback, more of a sideways than anything else. We're perhaps a little bit elevated here, but there's no reason why this trend, albeit with perhaps a little pause, that would be good in the next couple of weeks, to be honest. So we'll see how that plays out. But the S&P had a very powerful week, and you can see the trends are as strong as ever. There's no weakness, there's no signs of wobbles there at all. And if we compare where we are now to the highs that we had, here's the highs in 2000. Here's the big picture double top, which occurred in October of 2007 at around 1560, and now we're trading 1,000 points higher than the peak of the GFC. It's been quite an extraordinary advance in the US market. Let's look at the Nasdaq, because that's been enormously strong. This is the QQQ, and there's been no change of character here. I've just left these notes on the chart. I've been showing these charts now for quite some time, and I talked about in this phase here what the possible outcomes were, that this would be a reaccumulation range, so a strong trend. We get a sideways movement, which constitutes a reaccumulation, so the market is gathering its momentum or reaccumulating its momentum again before it advances further. And of course, that of the three outcomes was the most likely and the one that's actually occurred. So the Nasdaq continues to power ahead, and you could see it also finished very, very powerfully as well. Now the Russell 2000 for small caps has cooled off just a little. It's really gone sideways during this period, where the other indices have continued to set new all-time highs. But look, it's only a whisker off its all-time highs. So there's no particular drama there. So the breadth in the American market remains very impressive, and no sign of breakdown whatsoever. Similarly in Europe, if you look at the DAX index, really strong on the DAX. It's had a real acceleration in the last week or so, and we're getting up to the deviation from the mean like we had back here in April. That preceded a bit of a pullback. It's not to say it has to happen again, but you can see unquestionably a very powerful trend in the German DAX. Looking at the UK index, not quite as strong, but nevertheless still trending in the right direction. So very powerful in Europe. Let's look at China. So China is this is the Shanghai Composite, is also rebounding, looking quite positive, and probably the most powerful of them all is the Japanese market. So this is the Nikkei. You can see we had a significant top here around just under 21,000 points, which was formed in 2015. We dropped from that 20,000 points to 15,000, but you can see now it's been an enormously strong move up on the easy money policies of the Japanese central bank. So looking very, very strong all around. The volatility index continues to trade well below 10 and basically at all-time lows. And you can see that there's really still a bit of a downward bias to the volatility. So no change there whatsoever. While I'm here, I'll just have a look at the US dollar. So we'll pan back, take a big picture look at the dollar. We didn't quite make this declining support line, but we've now moved up. We've formed higher highs and higher lows, and a series of them. So for now, the US dollar would appear to be heading higher, and certainly with the US economy going the way that it is, and the fact that the Fed policy is going to be tightening more quickly than anywhere else in the world, there's every likelihood that the US dollar will continue in an upward path. Now the Australian dollar got up to around 80, 81, but is now pulling back and is back in the 76s at this point in time. So it's back into that trading range that it had been in for quite a lengthy period of time. So just looking at a couple of the top stocks, I just thought I'd highlight with some actual data what's happening with some of these global dominators. So Facebook growing their sales at 47% per annum. They've got a very healthy operating margin of 50%. And yet the market fixated on the fact that they were raising costs as a security measure to try and head off this fake news that's occurring. Facebook is going to be adding about 20,000 employees to try and combat this problem, and Facebook sold off. But look, I think that'll prove to be quite temporary. So very, very robust sales and profit growth. Alibaba, the Chinese giant, which I think is better than any of the American peers. Revenue was up 63% on Alibaba, so they came in with an excellent earnings report as well. Aussie Stocks, our dollar was down. We had some quite poor retail sales data, and I think that's another reason that the Australian index is going to struggle. The ASX 200 index was up 57 points for the week, but it still can't breach the 6,000 point level. We'll look at that in a minute. And as I mentioned, this is post-dividend period, so it's poor seasonality for banks as well. Let's just take a look at the Australian market. So there's our index. It's finished quite positively, but still unable to break through the 6,000 level. Let's see what happens on Monday. Now we'll check in on gold. This is gold on a daily basis. We managed to spike up when the North Korea situation was in full flight. In September, we spiked up to 1350, but we've pulled back now to 1270. Looked at on a weekly chart, you can see that we're still really just in a big trading range. If we pan back a bit further, we've managed to break out above this long-term downtrending line. So we had a nice breakout, but was unable to break above this peak here from July of 2016, which is coming in at around 1375, and that was an exact 38.2% retracement from the peak in 2011 down to the absolute lows in 2015. So technically this is shaping up very well. Exact 38.2% bounce and then a trading range forming from there. And gold stocks are really reflecting the that trading range because there's nothing much happening in gold stocks. This is silver. It's probably performing a little bit worse than gold. I'm not sure how to interpret that, but it's just a sector that there's not really any traction there at the moment. Turning now to GDX on a weekly chart, you can see we're still in this rising triangle, but there's just no momentum there at all. Excuse me, and you can see that the trading volumes are actually slipping away. So decreasing trading volumes, smaller and smaller variations, and there's really nothing much happening in that sector at the moment. So gold was down by $10. GLD Holdings, the world's biggest ETF, edged down a little bit, 846, but it's still remaining fairly solid. So that's a bit of a positive. And precious metal stocks, there's just no traction there at all. And to my mind, and I've been saying this for 5 years, I don't think there's a better gold stock on the planet than Northern Star, which is a local Australian gold stock if you're not familiar with it. And no surprise, the price of Northern Star is trading near its all-time highs, and that pretty much says it all compared to the rest of the gold sector. Looking at other commodities now, copper eased back a little bit on currency, back to 311, but crude oil did well. Finally broke that 52, 53 resistance and was trading up at 55.5. So that's been a very significant break of resistance, and as a consequence, stocks responded quite strongly. So it did very well. So you'd have to say that the sector is now a buy on any little pullbacks. There's the spot copper chart. Not much happening there in the last few weeks, but there's the big breakout in crude oil. So very positive for crude. So to wrap it up, it would be easy to conclude that there may not be a pullback before Christmas, and I say that very much tongue-in-cheek because I do not try and predict the market. I play it as it comes at me, and it would be easy, given the way things are going, to perhaps get drawn into the fact that there may not be a pullback before Christmas. But from a good practice point of view, I think still buying the dips is the way to go. But stepping back on a medium-term picture between now and the end of the year, irrespective of what may happen in the middle, everything is lined up for global stocks to continue to advance. It's really hard to see that not happening. So the considered execution of a sound plan is absolutely paramount. I know that I bash on about this all the time, but in my experience, very few people actually get real clarity around what they're doing. That's the first step. Be very clear about what you're doing, and then secondly, find a way to execute that plan in a very considered and sensible manner. And remember, for those that are nervous about the fact that the market's been running so hard for so long, and I've shown this, I do this 3 or 4 or 5 times a year, there will always be a time to get out well in advance of a major top. You always get 3 to 6 months, possibly longer. Before the GFC, the signs were evident around January of 2008. The worst of the GFC didn't really hit until August, September of 2008. There's always plenty of time to get out ahead of a major top. So fear of that occurring should not be keeping you out of the market. And in any case, you can always profit from the ensuing bear market. It's all about being able to recognize that the character of the market is changing, and then secondarily and most importantly, actually responding to it rather than being sort of stunned like a rabbit in the headlights. Fear of a downturn leads to poor decision making. It's just not helpful. So I'd really encourage you, if you are a bit fearful of what the market is doing, then you've just got to try and find a way to get around that. Now, portfolio analyst this week, I'm going to be analysing the Bitcoin chart. I'm not a supporter or enthusiast for Bitcoin by any stretch of the imagination, but I know that many people are becoming extremely interested in Bitcoin. So I'm going to be analysing that, and just as I've said earlier, there's a free trial and offer for anyone that wants to take advantage of that. There's my contact details for anyone that wishes to communicate with me, and we'll be back with you next week. Cheers.